Hey everybody, Marty Missouri here. It is after hours on Thursday, the 5th of October, 2023. Clients, you'll get this in an email, link to an email tomorrow morning as your Friday message. And then later tomorrow, I imagine, or at the latest sometime over the weekend, I'll give you the economic update. So true to recent form, I'm just going to deliver the message that I want to deliver today. And then for those of you who want to stick through some chart analysis, then we'll do that in the second part. So I wanted to today get a little bit more into the weeds in terms of what we're actually doing in our core portfolio, just briefly, not a lot of detail, but just kind of the surface. And a little bit about why as we go. A lot of that comes out, of course, on the economic update to get a feel for how we think about general conditions. And then I want to go through some past trends over the last few decades, bull markets, bear markets, how stocks have reacted, bonds, commodities, and so on, and let you know what we're thinking going forward once we get through whatever's left in the current cycle. We manage a core portfolio that reflects our view of the global risk-reward setup, if you will. And then we score it internally from a risk standpoint on a scale of 0 to 100. And then with regard to clients, we actually get to know our clients very well, and then we score them, frankly, on a risk-reward scale, same scale. So let's say, for example, we think our portfolio right now would rank a 60 or score a 60 on a 0 to 100 scale, which would be kind of a moderate risk portfolio, if you will, moderate, maybe a little bit growthy, but nothing super aggressive. And if we rate a client anywhere from a 60 to 100, well, then they're going to get the full complement of our core portfolio. Now, if we have a client, and we have some who rate more conservative than that, let's say they're a 40, well, then we're going to do the math, and they're going to have less than a full allocation to our core. And what's nice about right now is that the balance, we can invest at 5+% in a couple of different places. But then again, anybody who rates higher than a 60 right now is only going to get a 60 because we just don't think it makes sense to go for more volatility or more risk in the present environment than that. Now, folks, anybody who's been with us over the last few decades, actually, since I've been doing this, know what it's like to have us very aggressive, something that rates a lot higher, and that would have been the 90s. It would have been from the bottom of the tech bubble to the top of the real estate bubble. And then, since then, all the way up to about August of 2019. And then we started hedging and getting a lot more conservative. And we've been relatively defensive relative to what we normally would be because of what conditions demand of us. So as we sit here today, that core portfolio sits just about 53% in stocks, and that's it. And just a slight bias to North America. Only 8% bonds, but that's actually growing. And the bonds right now are mostly treasuries. We have kind of a barbell approach right now. And then we have a couple of funds that invest in emerging market bonds, which we are actually pretty bullish on, or we will be on a go-forward basis. Then we have 18% commodities. 40% actually is gold. Almost 40% is in ag commodities wrapped up in an ETF. And then silver and base metals futures make up the remaining 20% almost evenly. And then the remaining 20% or so is, call it cash equivalents, but we're earning better than 5% right now. For the moment, we're using a treasury money fund. So we like that position. It gives us plenty of buying power when we think it's time. And then on top of all that, and this is what probably brings our risk down notably less than a 60, if that's where we are right now, is that we're presently hedging fairly close to the money with S&P 500 put options, which dramatically limits the downside exposure to something dramatic to the downside, a waterfall kind of sell-off like we had during COVID, and thankfully we were hedged pretty good then, so our clients really didn't feel much when everybody else was down 30 to 40%. So clearly we still think there's that kind of risk out there in the market still. Whether it occurs over a 3-week period, of course, remains to be seen. That was quite dramatic. But yeah, we do think there's risk for something precipitous over a short period of time. So that's, without any detail into individual securities and so forth, that's as much as I'm comfortable sharing publicly on a video. Non-clients, we are not making recommendations here in any way, shape, or form. So if there's information there that's useful to you, fine. Ultimately, if you're not our client, you're going to make your own decisions. And if I can help out in terms of just giving you some perspective and some things to think about, great. But you're going to do your own research or talk to your own advisors and make your own decisions. So this year has been really something to behold. In fact, when you consider the U.S. stock market performance, we actually had a pretty nice January. We were up pretty nicely and the market was up pretty nicely. Into mid-February, began to roll over. We had that March corrective action around the regional bank scenario. And then, of course, the Fed stepped in. The market rallied out of that. And I'm going to have to define what I mean by market here in a second. And then the AI craze kind of, took off and ultimately pushed the S&P 500, at least on the surface, to valuations that really do not reflect, among other things, the current interest rate environment, let alone what we expect to happen to earnings if indeed we're right on our recession thesis. But it really was the S&P and the NASDAQ, comp and the NASDAQ 100 indexes, because when you look at the market from pretty much March on, not much has happened anywhere else. In fact, right now, the Russell 2000 index, which is small cap index, is down right about 1.75%. The New York Stock Exchange Composite Index is in the negative now, just under 1%. The Dow is in the negative now, just under 1%. And the S&P 500 equal weight, which is those 500 stocks, each one getting equal measure in the index, is down 1.5% year to date. The S&P 500 year to date is still up 10.9%, down a bunch from where it was late July. But as I've said a zillion times here, and you've heard other people say it, I'm sure, you take out just a handful of stocks and it's right down there with everybody else. So now, despite what you might hear on places like CNBC, if you happen to watch that channel, I don't, but people tell me that you get some pretty bullish narratives there, and you might think, listening to certain people, that the market's having a historically good year. Unequivocally, it's not, if we're talking equities. In fact, I just looked before I hit the record button. Year to date, 269 of the S&P 500 stocks are down on the year, negative. So take that for what it's worth. It's still a bear market, almost however you slice it, unless you take that thin slice, which includes just a handful of stocks, literally. So for what that's worth, it essentially says that no, we're not out of the woods, and the market probably is anticipating, when you look at the real results, potentially more pain ahead, and we think that's a macro or an economic phenomenon that ultimately brings that on. I've been talking a lot about how the trading's been happening lately. This morning I put, bad news is good news in the written blog's title, because that's how the market is trading. When we get some soft economic news, the market rallies, the stock market does. Tomorrow we get the BLS, Bureau of Labor Statistics jobs number. And if it's soft, and I think it may very well be, stocks are going to rally. And we'll get into that in the technicals here in a minute. Ultimately, it's soft data that's going to take the market down if indeed that risk plays out. It's going to be earnings falling due to folks not spending money any longer. But in the meantime, all that is just kind of this myopia, this fixation on just what the Fed is doing. And I get it when you look at how impactful the Fed can be. But I've illustrated here more than once what happens while the Fed is being accommodated, but we're in recession. It's a dangerous time to be loaded up on equities. Those of you who just want to listen to the narrative, stick with me on these charts. We're not going to get into complicated technicals. But on the screen in front of you, the top panel is the MSCI Emerging Markets Equity Index, which is that line right there. Call that orange. The blue line is developed markets, right? Advanced economies, but non-US. And that line right there, the white line, is the S&P 500. This is the long-term Treasury bond index, the pink line in the second panel. This is gold, this orange line in the third panel, and this is the Bloomberg Commodity Index. And then in the fourth panel is the US dollar, DXY, the dollar index. So let's just go back, and I'm going to type in 1990, and let's just take a look at that amazing period that was the 90s, and let's see what worked during that stretch. So clearly, for half of it, emerging markets were working really well. What I did is normalize this starting at 0. So this is the rate of return, up 160% through 3/4 of 1994, from January of 1990. But ultimately, when it was all said and done, U.S. stocks were up 309%. Emerging markets were up 122%, and developed markets were only up 68% for all those years. Bonds did pretty well, up 135%. Gold was down 27%, and the Bloomberg basket of commodities was down 3.5%, and the dollar was up 8% during that time period. So the trend in the dollar was higher, the trend in U.S. stocks were higher, and notice that when the dollar really started taking off, how emerging markets flatlined and then ultimately rolled over. There's a very negative correlation between the U.S. dollar and emerging market equities. Also, you can see gold pretty much topping out as the dollar was really taking off the second go around here. Okay, so if I just take us to the tech bubble peak, we'll call it, to that just really tough 30-month or so period to March of 2003. Let's take a look at what did well during that period of time. So stocks rolled over really hard. 46%, it's actually more like 50, so there's not quite getting the day right there, but close enough. Hit to the U.S. stock market, big drop. Emerging markets down 46%, and then developed foreign markets down 50%. The bonds up 40% during that 3-year time period, right? So bonds can be very defensive and work really well during recessions. Gold up 22%, commodities up 26%. Again, stocks are getting killed. Gold and even commodities did well here on the second part of that bear market. The dollar down 7% during that time period. So a weaker dollar helps commodities. It can help stocks as well, particularly emerging markets. You can see emerging markets did try to recover there a little bit, but we had a real meltdown in global equities. We didn't have a really bad recession at that point, but indeed we had a meltdown in global equities. So now I want to take you from that bottom to the top, which I'm going to say was middle of 2007-ish. So here, ironically, emerging markets were up massively over just, what is that, a 4 and 3/4 year period there, up 361%. Foreign developed markets up 163%. U.S. stocks up only 75% during that same time period. I mean, it was a bull market, shouldn't complain, but huge outperformance by foreign securities. Bonds hung in there, 26% during that time period. Gold actually had a pretty good run, up 125%. Commodities made some money, up 45%. The dollar was down 22%. Okay, so remember what I said. The negative correlation between the dollar and emerging markets, and of course between the dollar and commodities, right? Okay, so then let's take that peak and take that to March, something about March, right? 2009, when the market bottomed, okay? So S&P 500 down 53%, actually it was down 57%, so I'm missing something there in terms of my top. Foreign developed market stocks down 60%, emerging market stocks down 62%, so just a rough go of it for equities globally during that big sell-off. Long-term bonds actually held up, right? You want to probably own long-term bonds when the world's melting down. Gold hung in there as well. Probably want to own gold when the world's melting down. Commodities, though, not so much, down 41%. The dollar rose 17%. So the world kind of rushes to the dollar, and they still do, when there's panic in the air. So now let's take a look at that bottom up until the market top, and I want to say that was February 20th, 2020. We had a long bull market, longest in history. U.S. stocks up, call it 400%. Emerging markets up 125, and developed foreign markets up just 120. So folks, it's a flip-flop, right? We had the 90s, which were all about the U.S. We had the between the bubble bull market, between the tech and real estate bubbles, which was all about emerging markets and foreign securities, right? In particular, when we look at stocks. Bonds doing okay still on the long end of the curve, right? Gold actually did okay during that period. Commodities, just a long, exhausting bear market, down 27%. The dollar up 12% during that time period. So folks, notice that over longer periods, there seems to be a correlation between the dollar and U.S. stocks doing pretty well. Gold can go up even when the dollar is going up, as you're seeing here. Commodities tend to have a very distinct negative correlation to the dollar. And bonds, sure, people are buying U.S. bonds, and that's helping the dollar out there as well. And then we had that just incredibly brief bear market. I mean, the market bottomed in like 3 weeks. Stocks were down 35-40%. But let's just take that to current. You'll see that here to the left of your screen. There's the COVID bear market, we'll call it. And then here's everything rushing out of that. U.S. stocks up 26% from that time period. Developed foreign down 1. Emerging markets down 15. Bonds down 34%, probably the worst stretch in history. I know 2022 was the worst year on record for long-term bonds. And then commodities up 33%, gold up 12%, dollar up 6.5%, still during that time period. Of course, the question now is, what should we expect going forward? So when you think about things that you want to get right, what the economy is going to be doing, what inflation is going to be like, where interest rates are going to be, what's going to be the trend in the dollar. I think if you get the dollar right, you're going to get a lot of things right. So the question is, once we get through whatever's left in this cycle, and we think there could be some pain left, and the dollar may rally on that, what would be the long-term most likely trajectory for the dollar? And this is a hot debate amongst a lot of people. I mean, there's some people that make a real strong case that there's a phenomenal amount of emerging market companies that have dollar-denominated debt that they're going to be servicing for years to come. It's in the teens of trillions, and therefore they're going to have always constant demand for dollars, and that's going to be pushing up the value of the dollar on a consistent basis. That's not my favorite thesis, by the way, but I understand it. And I haven't heard people who push that narrative acknowledge the fact that emerging market entities own a tremendous amount of U.S. assets. Now, it's not that each borrower has excess, U.S. assets that they can sell, but when you put it all together and you look at it in the aggregate, there are plenty of U.S. assets that can be sold for dollars, right, ultimately, to provide the currency with which to service and to pay off that debt. The other thing is that when we look at, for example, and this is just equities we're talking about here, but we look at the valuation mismatch. This is just a year-to-date chart of the price-to-earnings ratio on the S&P 500, which is historically high, versus the price-to-earnings ratios on emerging markets and developed foreign markets, which are historically low, right? So if global investors are looking to find value, right, from just your most basic valuation metrics that most people are familiar with, U.S. stocks look really pricey relative to the rest of the world. And if the rest of the world starts waking up to that and starts finding reasons to buy these over U.S. stocks, well, then that right there would be downward pressure on the dollar as folks sell U.S. assets to buy foreign assets. So that's just one element there that can really take off. then you kind of get into the weeds. And over the last couple of years, I've written a fair amount about this. And, the U.S. is 123 or something like that percent debt to GDP. The last time we had over 100% debt to GDP was the mid-1940s, coming out of World War II. We were, bringing the soldiers home. We had the rest of the world to rebuild, and we were going to run big, massive budget deficits like the U.S. is now and will for the foreseeable future, at least, right? So the war debt was short-term debt, right? That was going to be refinanced in a very inflationary environment. COVID debt that the U.S. took on to send everybody trillions, very short-term. They blew it, quite frankly. They had an opportunity to term out a lot of that new debt or get it out there on the yield curve where it was real cheap. They didn't, right? They very myopic the way they handled that. So that debt coming due, like the war debt in the 1940s, comes due in a much higher interest rate regime. Now, it's not all coming due tomorrow. Please, folks, resist these doomsayers. It's $1 trillion interest payment already, but it doesn't go to like 50 trillion. I'm exaggerating. Tomorrow, there's still a lot of longer term debt at low interest rates, but a lot of it's going to be refinanced, and they're running $1 trillion+ annual deficits. And if the economy gets weaker, that's just going to get worse at a time when there's less tax revenue, right? So anyway, long term, the way the U.S. is notorious for ultimately defaulting on its debt, and it won't be because they didn't make dollar payments on it, it's because they deflated the value of the dollar, right? So the Federal Reserve Bank actually in the 40s actually implemented true yield curve control, and out the curve they capped treasury rates at 2.5%. So the government could refinance at 2.5%, and the economy, inflation, was running hotter than that. So we had negative real interest rates. So in some way, shape, or form, yield curve control is very unpopular, right, politically. And a lot of people say it just doesn't work. Well, it'll work if we want to keep interest rates and the cost of borrowing relatively low for the government. And that will also translate to lower borrowing costs for the community, for consumers, if you will. And there's a demand-driven environment that would push inflation and therefore the economy higher. So by 1952 or so, we went from 116% debt to GDP down to 80%, and they were able to kind of work their way out of that yield curve control. And by the time we got to Paul Volcker, in the late 70s, raising interest rates, well, he could do that because we only had 30% government debt to GDP. Now it's like 123%, like I said. So that is a scenario where the dollar, the pressure on the dollar is going to be downward in a scenario where in the U.S. you have negative real interest rates, where meaning inflation runs hotter than interest rates themselves. And by the way, if you want to come up with the ideal setup for gold, that's it right there. So our view is, recession, more pain coming. Dollar probably continues to rise into that, although I think it's going to come in fits and starts. If we get a weak jobs number tomorrow, the dollar will go down, right? And stocks will rally, I think. And interest rates will go down, bonds will rally tomorrow, but that's all short-term stuff. We get beyond all this stuff, then we're going to be off to really settling into this new labor-friendly, higher inflation regime with lots of global macro themes that we can take full advantage of. So, like I say to clients in every review, you and I may not really appreciate the world we're about to, settle into. But my, oh my, it's going to be rich, absolutely rich with macro investment opportunities. But it's not time yet to really exploit those in a big way. Hence, the relatively conservative to moderate allocation. So, folks, hope that was, instructive. I wanted to get a little deeper into the long-term weeds and let you know what we're thinking. Those of you who do not want to suffer through the technical analysis, which I'm going to rush through here now since I took so much time, thank you very much for watching and listening, and look for the economic update within the next day or two. Okay, so for the rest of us, let's take a look at the S&P 500. I had actually the hourly chart. I don't think I've done this one with you for a while. And the reason I was just kind of looking at, what's the setup going into tomorrow. So remember the last market update, and I'll show you on the daily, I pointed to 4,200. In fact, here it is on the hourly chart, 4,200. as potentially pretty strong support. And sure enough, we bounced off of that. But just on the short-term chart, right, at least on the hourly, we had very strong-looking bullish divergences. So you have a lower low on price, higher low in terms of momentum, and you had a falling wedge. So that breakout should be of no surprise. Whether or not it actually sticks remains to be seen. So much short-term rests on tomorrow's jobs number, make no mistake. When we go to the daily chart, recall that I said you got the 200-day moving average and 4,200. That is going to be support. Sure enough, boom, off of that. Big, nice rally yesterday. Tried to fall back down, almost tested it today, ended, kind of on an upswing. We do have I think a classic bear flag that would take us down to about 4,000. But without that, you've got a falling wedge pattern, but you do not have anything bullish down here. I mean, we could get a massive boost from tomorrow's jobs number. And remember, as I said, I think it was in this morning's written blog post and in Monday's update of our equity market conditions index, sentiment has turned pretty sour. It's not historically sour at this point. It can get a lot more sour and the market can go a lot lower, but there's enough there that could get, a panicky move to the bull side of the boat, and then that could push stocks up higher as well. So, somewhat ambiguous, but I would be leaning towards a rally, technically speaking, certainly on that hourly chart. But if it's a strong number tomorrow, stocks are going to suffer, make no mistake. And then the NASDAQ 100 ETF hourly chart, kind of similar, maybe not quite as compelling, more of a consolidation pattern there, but you do have your bullish divergences. Looking at the daily, you've got maybe your bear flag there. Still more of that, little different setup than the S&P. That is not a bullish divergence. That almost is, but not quite. So yeah, this can go notably in either direction. And 350, we called that out when I showed you that volume analysis. Boom, hit that one just right on cue. Consolidated up a little bit to create that flag. If we break down there, there's maybe a little support around 340, but I think that 200-day moving average could be the next stop if indeed we begin to break down. Ultimately, in a recession scenario, folks, it's quite a bit lower, we think. So folks, that took much longer than I anticipated. Thank you for sticking with me that long. Bottom line is, longer term, we think that investors are going to be in for a nice run if they get certain things right, particularly the dollar. And by the way, the gains are not going to be where they were. It's not going to be all about U.S. tech stocks. I have high conviction, as you can tell, during the next bull market. Not that we won't own some, no doubt we will, at least some of them, but not where we see the overall macro value like we do in other parts of the world, and like we do, frankly, in commodities. I don't think I mentioned, but commodities and commodity producers the next go around, as opposed to the last, which was really the commodity consuming countries that you wanted to be investing in. So again, I'll leave it there, folks. Thank you so much, as always, for watching and listening, and I'll be back in a day or two with your economic update. Take care. Bye-bye.